Hey everyone, my name is Harsh Srivastav, and in today's video, we'll be looking at why investing in bonds might be the right option at this point of time. But before that, let me also give you a brief overview of what bonds are, what are some of the key terminologies that you must be aware about, what are the risks that are involved when investing in bonds, and lastly, why this might be the right time to allocate some percentage of your investment corpus towards bonds. So without any further ado, let's get straight into the video. What are bonds? So when corporates are in need of money, they usually have three options to raise capital. The first option is to sell the shares of the company. This option does not put any interest burden on the company. However, the shareholding of existing investors is diluted. The second option is that the corporate can take a bank loan. However, with a bank loan, there also comes the problem of interest burden on the company. The interest on business loans is usually 12% and can go as high as 26% in some cases. Now, corporates have one more option where there is no dilution required by the existing shareholders, and even the interest burden is lower than the bank loan. Yes, this is where bonds come into the picture. Bonds are basically debt securities which are issued by the corporates, and in return these corporates pay the bondholders an interest on the principal amount. So we can say that in a way, bondholders are the lender for the company. Now the interest rate on corporate bonds is usually more than FDs for the obvious reason of enticing investors to take some additional risk for the extra return they receive on bonds. At the same time, it is also lower than bank loans because otherwise, what's the point of taking all the hassle to raise money from so many bondholders? Now, I talked about corporates so that you don't get confused and you easily understand what bonds are. But corporates are not the only ones who issue bonds. Even state governments and central government can issue bonds for funding of different infrastructure projects. The interest rate on government bonds tends to be lower than corporate bonds for the mere reason that government securities come with sovereign guarantees and so they carry a lower risk. The next question that should arise in your mind is, where exactly are bonds bought and sold? Well, to answer that, there are basically two types of bond market, the primary market and the secondary market. Primary market is where the bonds are first created and the money goes directly from the investor to the issuer of the bond. The secondary market is where the existing bonds are traded among the investors. So people who are looking to exit from their bonds usually find a buyer in the secondary market. Moving ahead, let's now look at some key terminologies that you must be aware about before investing in bonds. The first term is face value. Face value is basically the amount of money that the issuer of the bond will pay to the bondholder at the maturity of the bond. The second term that you should know about is the coupon rate. The coupon rate is nothing but the interest payment that the issuer pays on the principal amount to the bondholder. The interest payment frequency varies from bond to bond, with some paying the interest yearly, some quarterly, and some even paying it monthly. Last but not the least, one should also understand the term YTM or yield to maturity. At this point of time, I want you guys to really concentrate because this is the most important part of the video. The yield to maturity is the effective return that a bondholder receives if he holds the bond till its maturity date. Let's take an example to understand better. Let's say you bought a 30-month corporate bond from the primary market for a face value of 1000 and the coupon rate on it was 10%. In this case, the bondholder would receive 100 rupees as annual interest on the bond. Now let's say that the same company issued a 30-month corporate bond in the primary market for the same face value of 1000, but this time at the coupon rate of 12%, meaning that the bondholder would now receive 120 rupees as annual interest. Now the old bond becomes unattractive for the investors because of the lower coupon rate of 10%. In this case, if you decide to exit from the bond before the maturity, then a new investor in the secondary market might want to pay just rupees 975 for the bond. Let's say only 12 months were remaining for the bond to mature and the new investor intends to hold the bond till the maturity date. In that case, the new investor will not only earn 100 rupees from the interest payment, but also earn rupees 25 extra when the principal amount of 1000 is paid back to the bondholders. Here the total earning for the new investor is 125 rupees on an investment of 975. So in percentage terms, the return is 12.82%, which is nothing but the yield to maturity for the new investor. Hope the concept of yield to maturity is now clear to you. Now, there are also certain risks that are involved when investing in bonds. First and foremost, there is the interest rate risk. As we saw earlier while explaining YTM, when interest rates rise, the prices of existing bonds tend to fall. This is due to the fact that investors are able to find better interest rates on their money elsewhere. So when investing in bonds, one should not only look at the coupon rate, but also take into consideration the price volatility due to the changing interest rates. Secondly, there is credit risk involved with bonds. This risk involves the possibility of the bond issuer to not being able to make the interest payment and the repayment of the principal amount. Rating agencies such as India Ratings and Research assess the creditworthiness of the issuers and assign credit ratings based on their ability to meet the debt obligations. AAA rated bonds are usually the ones that have the highest probability of repayment, and all bonds that are rated BBB and above are considered investment grade. The third risk involved with bonds is the inflation risk. Inflation is the enemy of bond prices. Usually, when inflation rises, RBI tends to increase the repo rate in response to it. The effect of higher repo rate is that the interest on FDs tends to rise. This makes bonds unattractive because the payoff for the additional risk taken becomes really less. The repercussion of this is that the bond prices tend to fall. Last but not the least, there is liquidity risk in bonds. Liquidity risk is basically the risk of not being able to find the buyer for your bonds. This risk is typically higher in case of bonds with smaller issue size. Therefore, it is recommended that retail investors should buy bonds where the issue size is large. Also, in some cases, in order to recoup your investment, you might also have to be invested till the maturity of the bond. Now, coming to the last segment of this video, why I think that this might be the right time to invest in bonds. The thing is, if we look at the stock market right now, there is a sideways trend. In a sideways trend, an average stock market investor is not able to make any decent returns. For example, in the last 1 year, the Sensex has only given a return of around 5%. Also, with the looming recession in 2023, the market is expected to see a correction in the second half of this financial year. At the same time, if we look at the macroeconomic parameters such as inflation, one can see that it has remained consistently above the RBI's upper tolerance limit of 6% for quite a while. To control the inflationary pressures on the economy, RBI kept on increasing the repo rate since May of 2022, and currently it stands at 6.5%. The effect of this is that interest rates on FDs of banks as well as NBFCs has risen a lot. This has made the return on bonds unattractive, and reduced demand means reduced prices for the bonds. But now the things are taking a turn. The inflation for March 2023 stood at 5.66%, which is under the RBI's upper tolerance limit of 6%. In this case, the central bank might want to raise the repo rate just once more to 6.75% in order to gain further control on inflation and thereafter pause the interest rate hike. Even in the US, due to the fall of the Silicon Valley Bank, the Fed is now more conscious, and it is anticipated that the Fed will pause the interest rate hikes to safeguard the banking industry. Now, if the situation is such that the inflationary pressures are under control and there is no further increase in the repo rate, then the bond market would be stable and the bonds will be available at very attractive prices because of the high interest rates on other low risk investments such as FDs. So in nutshell, if one is able to secure some good bonds at attractive prices, then one can make better returns than FDs as well as the sideways moving stock market. One should have a keen eye on the yield to maturity of the bond so that they can make the best returns if they hold it till the maturity. Hope you found this video helpful and that you were able to learn something new today. Thank you so much for watching. Like the video, hit that subscribe button and stay tuned for my next video.